Welcome to the deep dive. Today, we're embarking on a pretty fascinating mission, unpacking the ultimate investment thesis for Bitcoin by Chris Millis.
Yeah, this isn't just, a static report.
Exactly. It's a living, breathing document that constantly updates, offers one of the most comprehensive, really in-depth looks at Bitcoin I've seen.
It really digs deep.
So our goal today, as always, is to pull out the most important nuggets, the key insights, basically giving you a shortcut to getting up to speed on this, let's face it, often complex topic. And just quickly before we dive in, if you're watching on YouTube, there's a link right in the description. You can view and download the whole document for free there.
Well, that's handy.
Yeah, and for folks on X, just head over to Chris Millis's X profile. That's Chris, Millas. Scroll to the highlights tab and you'll find it right there.
Great. And, what's really interesting about this thesis, as you said, is how it starts. It doesn't just jump into Bitcoin. It actually takes a step back and redefines money itself. Lays this crucial foundation first. It's sort of like needing to understand the rules of chess before you can appreciate a grandmaster's move.
That's a great analogy. So, okay, let's unpack that first bit then. The document asks fundamentally, what is money?
Yeah.
It calls it an information system, a tool for storing and transmitting value, almost like the language of value in an economy.
Language of value. I like that.
Without it, we'd basically be stuck just producing and consuming right now, Less saving, less capital building up, which ultimately means lower living standards for everyone.
It enables that delayed gratification, that future planning.
Precisely. And it gets even more conceptual. The thesis throws out some surprising definitions. Like from an evolutionary angle, money is liquid fitness.
Liquid fitness. Okay, unpack that.
Meaning it's easily convertible into almost anything else you need for survival or advantage. And maybe even deeper, it calls money the highest form of energy human beings can channel.
Because you can turn it into almost any other kind of energy or resource.
Exactly. And practically, it solves that old economic problem, the coincidence of wants. No more needing to find someone who wants your chickens and has the cow you need. Money makes indirect exchange easy.
Right, it gets rid of that friction, which leads straight into a really core idea in the document.
Yeah.
The difference between easy money and hard money.
Okay.
Easy money, its supply is, well, easy to increase. Think modern fiat currencies. Hard money, much tougher to inflate the supply.
And how do they measure that hardness?
With the stock-to-flow ratio. Basically, you look at how much of something is the stock versus how much is produced each year, the flow. Higher ratio means harder money. Think gold versus, say, copper.
Gotcha.
And this ties directly into Gresham's law. You've probably heard it. Bad money dries out good.
Yeah, people spend the stuff that's losing value and hoard the stuff that isn't.
Exactly. So the thesis argues that over time, wealth tends to flow towards those who choose the hardest, most saleable forms of money. And it defines sound money based on that freely chosen, owner-controlled, safe from manipulation, and ideally gradually increasing in purchasing power.
Saleable. That's the key term here too, isn't it? Money is the most saleable good.
It is. Sellability across 3 dimensions, the document says. Time, does it store value? Space, can you transport it easily? And scales, can you divide it or group it easily?
Okay, so those properties feed into its main jobs. The document highlights 3 essential functions of money, right?
Correct. First, store of value. It's got to hold its purchasing power over time.
They use that analogy. Fat is deferred caloric energy. Money is deferred monetary energy. Kind of visceral.
It really is. If you can't store that economic energy, you're in trouble down the line.
Then, medium of exchange. Widely accepted for payments, like gold becoming the standard in the 19th century, which fueled a huge boom in global trade because everyone accepted it.
Right, reduced transaction costs massively.
And finally, unit of account. A common yardstick to measure value. Apples and oranges, priced in the same thing.
And these 3 functions are only possible because of money's underlying properties. The document lists 6 key ones.
Let's see if I remember. Acceptability, divisibility, durability, fungibility, meaning one unit is the same as another portability, and scarcity.
You got it. Those properties enable the functions across those dimensions of saleability we mentioned. And the thesis adds this concept of monetary premium.
That's the extra value something gets just because it works well as money, beyond its basic use.
Precisely. And that premium tends to drain away when a better form of sound money comes along. People migrate.
Which sets up the whole evolution of money idea.
Yeah, the 4 stages. Starts with collectibles, then things become a store of value, then a medium of exchange, and finally a unit of account. It's a progression.
And the history reflects that. We started with commodity money, furs, salt, beads. Pretty bad across space and time, usually.
Right. Then metallic money, gold, silver. Much better across time, gold especially, but still clunky across space. Heavy, hard to move securely.
Then paper money. Dollars, euros, yen, great across space, lightweight, easy. But terrible across time, historically speaking. Governments just can't resist debasing it.
Yeah, the temptation is always there. Which leads the thesis to argue that digital money is the next logical step, potentially effective across both space and time. Infinitely durable, travels at light speed.
Okay, perfect transition. Now we bring in Bitcoin. The document positions it as exactly that, the next evolution, the digital revolution of money. So what is Bitcoin? The definition given is the first decentralized, global rules-based, peer-to-peer digital monetary system. Quite a mouthful?
It is, but each part matters. Decentralized, global, rules-based P2P.
And they describe it in interesting ways, too. Digital real estate without the risks of physical real estate. A digital commodity without physical commodity risks.
Yeah.
Digital tech without physical tech company liabilities. It's sort of framing it as a unique new asset class.
It really tries to break old analogies. And you see big names echoing this. Larry Fink calling it a way to protect yourself from global debasement. An international ledger, bigger than any government.
And Elon Musk saying its structure is very ingenious, a much better way to transfer values.
Yeah, high praise. The document also touches on the origin, Satoshi Nakamoto, the unknown inventor.
But it makes the point that who Satoshi is, it's basically irrelevant now, like asking who discovered fire or invented the wheel.
Right, the focus is on the system itself, its decentralized nature from the very beginning. That anonymity actually reinforces the decentralization.
Okay, let's get into some core mechanics highlighted in the thesis. First, the participants.
You've got miners who validate transactions and secure the network. Node operators who relay transactions, verify rules, keep copies of the blockchain. Full nodes, light nodes, mining nodes, developers contributing to the open source code, and users, obviously sending, receiving, storing.
And arguably the most famous feature, Bitcoin's capped supply.
Yes, the 21 million limit. Satoshi's deliberate choice for absolute scarcity, protection against inflation, value preservation baked into the code. Tim Draper's quote sums it up. Bitcoin is the safest money out there, because that supply cap is enforced by the network consensus.
What about transaction finality? People worry about that.
Good point. The thesis explains confirmations. Each block added on top of your transaction makes it harder to reverse. Typically, after about 6 confirmations, roughly an hour, it's considered practically irreversible or final. Compare that to credit cards, where chargebacks can happen months later.
Big difference. And underpinning the security is its encrypted nature, right?
Absolutely. Encryption is the defense mechanism, ensuring that, as the document puts it, monetary energy doesn't decay, debase, or diffuse. It protects the integrity of the value stored and transferred.
Okay, so here's maybe the core argument of the whole thesis. Bitcoin doesn't just have the properties of money, it perfects them.
That's the claim. Because it's digital, things like portability become supreme, speed of light transfer. Divisibility down to tiny fractions of satoshis. Durability is infinite. And scarcity is absolute and verifiable, which is unprecedented.
So if it perfects the properties, it follows that it perfectly performs the functions too. Store of value, medium of exchange, unit of account.
That's the logic, yes. It excels as a store of value due to scarcity and durability. It can be a medium of exchange, especially with layer 2 solutions. And as it gets more adopted, it can become a global unit of account.
Let's put that comparison side by side again. Commodities, fiat, gold, Bitcoin.
Okay. Commodities fail across space or time. Fiat, good across space, fails across time, debasement. Gold, good across time, fails across space, physical. Bitcoin, the thesis, argues it combines fiat space efficiency with gold's time efficiency. Digital gold, essentially.
Which leads to that quote, gold was money for the kings, fiat was money for the government. Bitcoin is money for the people.
A bit punchy, but it captures the shift towards decentralization and individual control. The document pushes hard on Bitcoin being a more efficient monetary system overall.
Even with the energy consumption debate.
Yes, because it argues that efficiency comes from cutting out intermediaries, eliminating physical transport costs, and leveraging decentralization for robust security and finality. It compares Bitcoin's energy use to the entire existing financial system's energy footprint, plus the military costs associated with protecting fiat systems. And reminds us, fiat is a young experiment too, average lifespan of failed fiat currencies. just 27 years.
Wow. So this efficiency helps it tackle the blockchain trilemma, that trade-off between decentralization, security, and scalability.
Right. Bitcoin prioritizes decentralization and security on its base layer, layer 1, then uses layer 2 solutions like Lightning to address scalability for payments. And fundamentally, it solves the Byzantine general problem.
Which is, remind us quickly.
How do you get a group of actors who might not trust each other and could even be malicious to agree on a single truth without a central coordinator? Bitcoin solves it using proof of work, basically, making it expensive to lie and rewarding honest participation.
Okay, let's zoom in on that engine room. Bitcoin mining. What is it, in simple terms?
It's using specialized computer hardware ASICs to basically guess solutions to a cryptographic puzzle over and over. Hashing. Think of it as rolling a giant virtual die billions of times a second. The first miner to find a hash below a certain target gets to create the next block, add transactions to it, and claim the reward.
And that reward consists of?
2 things. Newly created Bitcoin, the block subsidy, and the transaction fees paid by users included in that block.
Got it. And 2 key mechanisms control this whole process, the halving and the difficulty adjustment. Let's start with the halving.
Okay, the Bitcoin halving happens about every 4 years. The block subsidy the new Bitcoin created gets cut in half. It's a pre-programmed event that controls inflation, makes Bitcoin increasingly scarce over time, and was designed to reward early adopters more heavily.
And the difficulty adjustment.
This is crucial. It's an automatic mechanism built into the Bitcoin protocol. Every 2016 blocks, which is roughly every 2 weeks, the network looks at how fast the previous blocks were found. If they were found faster than the target 10 minutes per block, the puzzle difficulty increases. If slower, it decreases.
Why is that so important?
It ensures blocks keep coming out roughly every 10 minutes, no matter how much computing power, hash rate, joins or leaves the network. More importantly, it ensures that the cost of producing a Bitcoin stays tightly correlated with its market price. This makes Bitcoin genuinely hard money. You can't just magically create more of it cheaply when the price goes up. The cost of production rises too.
So the difficulty adjustment acts like a free market mechanism itself, self-regulating.
Exactly. The document draws that parallel. Both adapt to changing conditions without central control, maintaining stability and efficiency. It's quite elegant, really.
Okay, what about the security budget?
That's simply the total value miners receive the block subsidy plus transaction fees. This budget pays for securing the network. As the subsidy halves over time, the idea is that transaction fees will eventually make up the bulk of the reward, ensuring miners remain incentivized to protect the chain.
And miners often work together in mining pools, right?
Yes, especially smaller miners. Pools emerged back in 2010. Miners combine their hash power, and if the pool finds a block, the reward is shared proportionally based on each miner's contribution. Smooths out the variance in earnings.
Now, the energy part again, proof of work.
What is proof of work? It's a consensus mechanism Bitcoin uses. It requires miners to expend real-world energy, the work, to solve those puzzles. This energy expenditure makes attacking the network prohibitively expensive and anchors Bitcoin's digital value to the physical reality of energy cost.
The document connects proof of work and capitalism.
Yeah, it argues both systems reward participants based on their contribution and competitive efficiency. They both incentivize competition, innovation, and growth through clear rules and rewards.
What about transaction fees? Who decides them?
Users decide how much fee to attach to their transaction. Miners prioritize transactions with higher fees, especially when block space is limited. So, it's a market, there's a trade-off. Higher fees generally mean faster confirmation and contribute stronger security, but lower fees are obviously preferred by users. Eventually, when block subsidies are gone, fees will be the only incentive, determined purely by supply, block space, and demand, transaction urgency.
Briefly, what's Nakamoto consensus?
It's the core rule. The longest valid chain, the one with the most accumulated proof of work, is considered the authoritative version of the ledger. Simple but powerful.
And we touched on Bitcoin mining and the energy grid. The idea that miners can help the grid.
Right. Because miners are location agnostic and seek the cheapest power, they can set up near stranded energy sources like excess natural gas flares or remote hydro dams, or they can soak up excess energy during periods of low demand on the grid, helping to balance supply and demand, especially beneficial for intermittent renewables like wind and solar.
So Bitcoin monetizes electricity, turns wasted power into a global digital asset.
That's the concept, a very different perspective than the Bitcoin boils oceans narrative.
Okay, shifting gears slightly, the document mentions the block size wars from 2015-2017. What was that about?
It was a major debate within the community. Big blockers wanted to increase the size limit of each block to allow more transactions, potentially lowering fees but making it harder for individuals to run full nodes due to increased data storage and bandwidth requirements. Small blockers prioritized keeping the block size small to maintain decentralization, arguing scalability should happen on layer 2.
And the outcome?
It led to a hard fork in 2017. Bitcoin Cash, BCH, split off with larger blocks, Bitcoin, BTC, kept the smaller block size, and focused on solutions like SegWit and the Lightning Network for scaling. The small blockers essentially won the argument on the main chain, prioritizing decentralization.
Interesting history. What about UTXOs?
UTXO stands for unspent transaction output. Think of it like leftover change from a cash transaction. When you spend Bitcoin, you spend entire UTXOs and get back any remainder as a new UTXO. Having lots of tiny UTXOs can make future transactions more expensive because they take up more data.
And this relates to things like ordinals and runes.
Yes, Ordinals found a way to inscribe data, like NFTs, onto individual Satoshis, the smallest unit of Bitcoin. This created a lot of activity, but also potentially a lot of junk UTXOs from related token standards like BRC20s. Runes is a newer, more efficient standard for creating fungible tokens on Bitcoin, designed specifically to avoid creating unnecessary UTXOs and work better with the Bitcoin ecosystem, including Lightning.
Okay, let's zoom out again. The document uses a lot of mental models to understand Bitcoin. Can you hit a few key ones?
Sure, anti-fragile gets stronger from attacks. Network effects, Metcalfe's law. Value grows with users. Scarcity, obviously key. Lindy effect, the longer it survives, the longer it's likely to survive. Shelling point, a natural focal point for coordination. Winner takes all or most market money tends towards one dominant standard. These lenses help explain its resilience and growth.
One powerful comparison is Bitcoin is akin to the internet.
Yeah, the idea is Bitcoin is like the base protocol layer, TCP/IP, for value transfer. Open source, permissionless. Applications get built on top, making the whole network more valuable. The key difference, you can actually own a piece of the Bitcoin base layer itself.
It's even called the sixth protocol layer of the internet stack, the value layer.
Right, enabling trustless transfer of value natively online for the first time.
Now, a controversial but important point, there is no second best or Bitcoin and path dependency.
This argues Bitcoin's creation was unique, unrepeatable. Satoshi's anonymous launch, no pre-mine, the specific initial parameters like proof of work and the 21M cap, these created a path that other cryptocurrencies, launching later with known founders and often pre-mines or ICOs, simply can't replicate. It's about that immaculate conception.
Bitcoin's conception was immaculate. Strong words.
The thesis uses it to emphasize the fair launch. No insider advantage, rules known from day one, founder unknown, and didn't enrich himself disproportionately. This fosters trust and decentralization in a way later projects arguably struggle with.
And that leads directly to Bitcoin is decentralized.
Absolutely. No central control. Power distributed among thousands of nodes globally, each with a full copy of the blockchain. No single point of failure. If part of the network goes down or has errors, the rest continues and self-corrects.
And because of all this, it's argued to be the ultimate store of economic value. Maximizing preservation, minimizing decay.
And anti-fragile, as we mentioned. It thrives on chaos. Every attempt to kill it has seemingly made it stronger.
Let's run through some other core properties highlighted. Permissionless.
Anyone can use it, no ID, no approval needed.
Trustless.
Doesn't rely on trusting intermediaries, just code and consensus.
Peer-to-peer.
Direct transactions between users.
Open source.
Code is public. Anyone can inspect or contribute.
Pseudonymous.
Addresses aren't directly tied to real-world identities, though transactions are public.
Borderless, has no issuer. Immutable.
Global, no central bank creating it. Transactions are practically irreversible.
Okay, let's hit that critical economic concept. Bitcoin and the Cantillon effect.
This is huge. The Cantillon effect describes how newly created fiat money enters the economy. Those closest to the money printer governments, large banks, connected corporations, get it first and spend it before prices rise. By the time it trickles down to average people, prices have already increased, eroding their purchasing power.
Like that water fountain analogy in the document. Closest get the fresh water.
Exactly. It's a hidden wealth transfer from the poor and middle class to the financial elite. Bitcoin, with its fixed supply and decentralized issuance, is presented as a direct counter to this. It aims for a level playing field where money creation doesn't benefit insiders.
Contrasting fractional reserve versus full reserve banking, Bitcoin enforces full reserve.
On the base layer, yes. Your Bitcoin is your Bitcoin. It's verifiably yours. Unlike banks that lend out most deposits, Bitcoin ensures 1.1 ownership, preventing money creation through credit expansion at the base level.
What about the Bitcoin flywheel?
That positive feedback loop. More users, higher price, more miners, more security, more trust, more users, and so on. It drives adoption.
And network effects, Metcalfe's law.
The value of a network is proportional to the square of its users. More users, miners, developers, merchants make Bitcoin exponentially more valuable and useful.
Money is winner take all or most? Why?
Because the benefits of using the same money as everyone else are enormous. More trading partners, greater liquidity, less friction. Networks tend to converge on one dominant standard. The thesis argues Bitcoin is the best candidate for that digital standard.
Bitcoin and Lindy effect. The longer it lasts.
The longer it's expected to last.
Yeah.
15 years is starting to look pretty Lindy for a decentralized digital system constantly under attack.
Bitcoin is the ultimate Veblen good. Explain that.
A Veblen good is one where demand increases as the price increases due to its exclusivity and signaling status. Think luxury watches or supercars. The argument is Bitcoin's absolute scarcity makes it increasingly desirable as its price rises, acting as a status symbol in the digital age.
Interesting. Bitcoin and Gall's law.
Gall's law states that successful complex systems invariably evolve from successful simple systems. Bitcoin started simple and has evolved slowly, carefully, layer by layer. It didn't try to be everything at once, which contributed to its robustness.
Bitcoin and mimetic theory. Imitation.
René Girard's theory. Humans imitate each other's desires, especially under uncertainty. As Bitcoin gains adoption and price appreciation, even people who don't fully understand it start wanting it because others do. Mimetic desire fuels adoption cycles.
And Bitcoin and time preference. This is fundamental.
Yes. Fiat currency, constantly losing value, encourages high time preference spending now, saving less, taking on debt. Bitcoin, being deflationary or appreciating over time, encourages low time preference saving, investing for the long term, delaying gratification. The thesis argues this shift could have profound positive societal effects.
Wow. Okay. The document lists Bitcoin's core principles. Truth, natural law, thermodynamics, self-reliance, honesty, fairness, technology, self-sovereignty. Quite a list.
It positions Bitcoin not just as tech, but as aligning with certain fundamental, almost philosophical principles.
Let's rapid fire some more core concepts. Bitcoin is digital scarcity.
First time we've had truly verifiable, enforceable scarcity in the digital realm. 21 million, period. Remember the quote, "When money is abundant, everything else is scarce. When money is scarce, everything else is abundant."
Bitcoin is backed by math.
Cryptography, consensus rules, fixed supply, all enforced by code and mathematics, not trust in people or institutions. Mathematical purity.
Bitcoin is apolitical.
Operates on immutable rules, outside the control of any single government or political party. Neutral infrastructure.
Bitcoin and the cost of defense. How is it cheaper to defend?
Defending physical gold or property requires walls, guards, armies. Defending Bitcoin primarily requires protecting your private keys, potentially just memorizing 12 words. The cost asymmetry is massive, incalculably easier to defend than to attack.
We heard Bitcoin is digital gold. Also, Bitcoin is digital capital.
Digital gold for its store of value properties.
Right.
Digital capital because it's a bearer asset you can use permissionlessly for economic activity, generating yield, etc.
Bitcoin is the exit strategy. From what?
From the traditional monetary system, from fiat debasement, from potential capital controls or financial repression, it offers an alternative path.
Bitcoin is a scoreboard for corporations.
Yeah, the idea is a company's success could eventually be measured by whether its Bitcoin treasury is increasing or decreasing relative to the total supply. Stack or be sacked. A bit extreme, maybe, but thought-provoking.
Bitcoin is digital real estate, prime property in cyberspace.
Limited supply, desirable location, the internet, highly valuable.
Bitcoin is for everyone, solving problems for rich and poor.
Provides property rights for those who have none, a savings mechanism for the unbanked, and an inflation hedge for the wealthy. Universal appeal, potentially.
Bitcoin and Darwinian fitness, adaptability.
It's constantly tested, bugs are found and fixed, the ecosystem adapts. It's a dynamic, self-correcting system.
Crucially, Bitcoin separates money and state. Why is that important?
The document gives 4 reasons. State control leads to manipulation and devaluation, enables economic control and distortion, infringes on property rights, and underpins the state's monopoly on violence, funding wars, etc. Bitcoin removes that control lever.
Protection from CBDCs.
Yes, Bitcoin is protection from CBDCs. Central bank digital currencies are seen as tools for surveillance and control. Bitcoin, being decentralized and permissionless, offers an escape from that.
Bitcoin is thermodynamically sound, aligned with physics.
Connects back to proof of work and energy. It aligns with natural laws rather than artificial human control like traditional finance.
Censorship resistant, rules without rulers.
Can't easily be shut down or censored. Operates on code, not commands from leaders.
Bitcoin is truth. How so?
The ledger is transparent, immutable, verifiable by anyone. It's based on mathematical proof, unlike fiat, which relies on trust in opaque institutions.
Bitcoin is true private property for the first time.
Because ownership is tied solely to knowledge of the private key, something you can hold just in your memory. Immune to physical confiscation in a way no other asset truly is.
Bitcoin is freedom technology, like the printing press or internet.
Decentralizes power, empowers individuals. Printing press broke the church's info monopoly. Internet broke communication monopolies. Bitcoin breaks the state's money monopoly.
Bitcoin is repricing the entire financial system. What does that mean?
The idea is that as Bitcoin absorbs monetary premium, other assets, stocks, bonds, real estate, will eventually be valued closer to their actual utility or cash flows rather than serving as imperfect stores of value, a massive reallocation of capital.
Like the digital revolution dematerializing money itself.
Exactly. Channeling monetary energy digitally, similar to how Facebook, Google, Amazon channeled social interactions, information, and commerce digitally.
Bitcoin and violence. How does it change the economics of violence?
Makes it less profitable. If property, Bitcoin, is easy to defend and hard to confiscate, the incentive for violence to acquire wealth decreases. Compare it to how the printing press undermined the church's ability to control information through force.
Bitcoin is layered money. Like TCP/IP has layers.
Yes. Layer 1, the main blockchain, is optimized for security and final settlement storing value across time. Layer 2 solutions, like Lightning, are built on top for speed and scalability, moving value across space efficiently.
Bitcoin as digital power projection. Nations using computation for defense.
Just like nations project physical power, military, they might start projecting digital power, hash rate, to secure their interests on the Bitcoin network or influence its future, protected by computing, electrical, economic, and political power.
How would we navigate a crisis on a Bitcoin standard?
Governments couldn't just print money to bail things out. They'd be constrained to taxation or transparent borrowing, forcing more fiscal discipline. A very different world.
AI, robots, and Bitcoin, how do they connect?
Bitcoin could serve as a native currency for autonomous AI agents and robots to transact with each other, or humans, without needing traditional bank accounts.
And what might life on a Bitcoin standard look like?
Potentially less war, harder to fund, more global trade, common neutral money, maybe lower time preference leading to more long-term investment and sustainable practices. Big picture stuff.
Finally, Bitcoin maximalists. What's their role?
The document frames them as the network's immune system, fiercely defending the core principles, decentralization, scarcity, sound money against changes or competing systems they see as detrimental. Controversial, but perhaps necessary for maintaining integrity.
Okay, that's a lot on the core nature and economics.
Right.
Let's briefly touch on scalability solutions, layer 2s, before hitting inflation.
Right. Bitcoin and layer 2s. These are separate protocols built on top of Bitcoin's base layer. They handle transactions off the main chain to increase speed, scale, and reduce fees, settling the final balances back on layer 1 periodically.
The most famous is the Lightning Network.
Exactly. It's a layer 2 peer-to-peer protocol. Users open payment channels between each other, conduct potentially thousands of transactions off-chain instantly and cheaply, and then close the channel, recording only the net final balance on the main blockchain. The document says, Bitcoin enables savings technology at scale. Lightning offers payments technology at scale.
Are there others? Stacks is mentioned.
Yes, Stacks is another approach. It aims to bring smart contracts and decentralized applications, DApps, to Bitcoin, using a consensus mechanism called proof of transfer, PODX, that interacts with the Bitcoin blockchain. Different approach to scaling and adding functionality.
Okay, now a major driver for Bitcoin adoption mentioned throughout, inflation.
Definitely. The thesis dives deep into Bitcoin, inflation, and currency. It defines inflation as typically resulting from fiat money supply expansion, leading to price increases, uncertainty, encouraging that high time preference, spend now, and fueling wealth inequality via the Cantillon effect.
And Bitcoin is a hedge against inflation and deflation? How both?
Hedge against inflation because its supply is fixed, protecting against purchasing power loss from money printing. Hedge against deflation in the sense of counterparty risk default, because holding Bitcoin directly involves no counterparty risk, unlike money in a bank during a crisis. It's insurance against both monetary expansion and systemic collapse.
The document is blunt. Why inflation is theft?
Argues it's theft because increasing the money supply arbitrarily devalues the existing money held by citizens, effectively stealing their stored time and energy, their life force, essentially.
And why inflation is stealth tax?
Because governments can fund spending by printing money instead of raising taxes directly, which is politically unpopular. It's a less visible way to extract resources from the populace.
But isn't some deflation good, like tech making things cheaper?
That's the point about Bitcoin enables technological deflation. In a sound money system like Bitcoin, lower prices resulting from innovation and efficiency gains would be accurately reflected. Your money would buy more over time. Prices naturally fall in Bitcoin terms, while they constantly rise in dollar terms due to inflation masking those efficiency gains.
So Bitcoin is protection from currency debasement. One Bitcoin is always one Bitcoin out of 21 million.
Exactly. While $1 today is worth far less than $1 from 20 years ago, that fixed denominator is key.
The document points to the U.S. debt spiral as a major catalyst.
Argues the U.S. and many other nations are caught in an unsustainable debt spiral, forcing continued fiat debasement. Bitcoin, as the hardest money, is positioned as the inevitable solution or escape hatch.
And this relates to currency wars.
When nations competitively devalue their currencies to gain trade advantages, it often links to trade wars, and historically, sometimes real wars. A neutral, global, decentralized currency like Bitcoin could potentially reduce this risk.
Okay, briefly, the document touches on Bitcoin and religion.
Just notes interpretations within Hinduism, seeing it aligned with freedom, and Islam debates, but some scholars deem it halal or permissible. Interesting cultural footnote.
More mainstream now, institutional adoption. This feels like a huge turning point.
Massive. The document compares the recent Bitcoin ETF launches to the gold ETF launch back in 2004, which preceded about 9 years of significant price appreciation for gold. It notes, though, that with Bitcoin, retail investors actually got in before the institutions, which is unusual.
The Bitcoin ETF is framed as a trade agreement between TradFi and DeFi.
Yeah, a bridge allowing massive amounts of traditional capital to flow into the Bitcoin ecosystem relatively easily through familiar brokerage accounts.
Like investment rounds for a startup. Seed, Series A, BC, and the ETF is the IPO.
That's one analogy used. Retail were the seed investors, VCs piled in. And now the ETFs represent the public offering, opening it up to everyone via Wall Street. Quotes from Larry Fink, Revolutionized Finance, fastest growing ETF, and Michael Saylor, competing against real estate gold S&P 10x to 100x bigger, really underscore the scale of this shift.
What's ETF and unit bias?
It's a psychological bias where investors prefer owning a larger quantity of lower-priced shares, even if the total investment value is the same. People feel better owning 100 shares at $1 than one share at $100.
How do ETFs solve that?
They allow fractional ownership easily. You can buy $50 worth of a Bitcoin ETF, getting a tiny slice without worrying about the high price of one whole Bitcoin. It lowers the barrier to entry and overcomes that unit bias.
And the loss leader concept for these ETFs?
Many ETF providers launched with very low or even zero fees initially, like a store selling milk cheap to get you in the door. The idea is to attract massive assets under management, AUM. As Bitcoin's price appreciates over time, even those low percentage fees on a huge AUM base will generate substantial profits for the issuers.
Okay, critical section. Addressing the doubts, risks, and qual-MS. What could stop Bitcoin?
The document is quite bullish, suggesting the only real way is a coordinated global shutdown of the entire internet permanently. And even then, it mentions alternative networks like radio or mesh. It also strongly asserts Bitcoin cannot go to zero due to its inherent utility and network effect.
Well, what about specific risks, like a major software bug?
Acknowledges it's possible, like in any software, but highlights the defenses. Rigorous peer review of code changes, the decentralized consensus making it hard for bugs to propagate universally, and the ultimate backstop of coordinating a rollback or hard fork to fix a catastrophic issue, like what happened once very early in 2010.
Self-sovereignty limitations, high fees for small users.
Yes, if base layer transaction fees become very high, it could limit the ability of average users to transact directly on layer 1, potentially pushing them towards custodians or layer 2s, which slightly compromises pure self-sovereignty. It remains to be seen how significant this becomes.
Tainted coins. Coins used illicitly being blacklisted.
A risk to fungibility, yes, but countered by technologies like coin mixing or tumbling services that obscure transaction history, making it harder to track specific coins. This enhances privacy and fungibility.
Regulation. Can't governments just regulate it out of existence?
Regulation can certainly create hurdles and limit adoption in certain ways or jurisdictions, but the thesis argues regulation cannot stop Bitcoin, fundamentally due to its decentralized, borderless nature. Like trying to ban file sharing globally, very difficult.
Concentrated supply. Whales controlling the market.
Acknowledges large holders exist, whales, but argues there's a disincentive to hoard too much in a competitive currency environment, especially if people can easily switch to alternatives if one currency becomes unstable due to manipulation. Low switching costs compared to traditional systems.
Artificial intelligence. Specifically quantum computing cracking the encryption.
A potential future risk, yes, but countered by the fact that Bitcoin is software. It can be upgraded with quantum-resistant algorithms well before quantum computers become a practical threat. It's an ongoing arms race, but one Bitcoin can adapt to. Elon Musk is quoted, "AI will never crack Bitcoin."
Okay, let's hit those frequently amplified qualms, the FAQs. I'll give the qualm, you give the thesis's answer. Ready?
Let's do it.
Q. Bitcoin is a Ponzi.
No, Ponzi schemes require a central operator promising high returns, funded by new investors' money. Bitcoin is decentralized, offers no promised returns, and its value is market-driven. Open, transparent code.
Q. Bitcoin is a scam.
A, no. It's open-source software. Anyone can audit the code. It operates 24/7 based on consensus rules, not trust in any person or company. The network itself has never been hacked.
Q. Bitcoin is backed by nothing.
It's backed by mathematics, cryptography, the energy securing the network, proof of work. It's immutable code, the time it's been operating, and its absolute verifiable scarcity. Value is subjective, derived from these properties.
Q. Bitcoin wasted energy.
It transforms otherwise wasted or stranded energy into monetary value. It incentivizes renewable energy build-out by acting as a buyer of last resort. Energy use secures the network. It's a feature, not a bug, when compared to the cost of the traditional system.
Q. Bitcoin is too volatile to be money.
It's volatile because it's in the early stages of monetization and price discovery. All new monetary assets, like gold initially, experienced high volatility. Volatility is expected to decrease as adoption grows and market cap increases.
Governments will ban it.
A. Many have tried. It survived. It's classified as property commodity in many key jurisdictions, like the U.S. It's increasingly embedded in public markets via ETFs. Its decentralized nature makes a truly effective global ban practically impossible.
Q. CBDCs will replace Bitcoin.
They are fundamentally opposites. CBDCs are centralized, permission, surveillance tools. Bitcoin is decentralized, permissionless, freedom-enabling technology. They serve entirely different purposes and values.
Q. Bitcoin is only used by criminals.
False. Chain analysis shows illicit use is a tiny fraction, less than 1%, and decreasing. Cash is far more dominant for crime. Bitcoin's public ledger actually makes it worse for criminals in many ways compared to untraceable cash.
Q. Bitcoin has no intrinsic value.
A, value is subjective. Bitcoin's value comes from its unique properties as a secure, decentralized, scarce, portable, divisible, durable monetary network. Its intrinsic value is its utility as the most robust monetary network ever created.
Q. Bitcoin is too slow and outdated.
A. Its base layer prioritizes security and decentralization over speed. Speed and scalability are addressed by Layer 2 solutions like the Lightning Network. It's also constantly being updated, e.g. Taproot upgrade enhancing programmability. It's slow and deliberate by design on Layer 1. So if you pull all these threads together, the core argument of the Millis thesis becomes pretty clear. Bitcoin isn't just an asset. It's presented as the next logical step in the evolution of money itself. It masters the necessary properties and functions. Its emergence driven by unique, unrepeatable circumstances, offering this profound alternative to traditional financial systems.
Yeah, it really connects the dots.
And thinking bigger picture, the document paints Bitcoin not just as tech, but as a fundamental shift in how humanity stores value, transmits value, with huge implications for everything from individual sovereignty right up to global power dynamics.
It's a compelling narrative. So the final thought for you, the listener, considering everything we've unpacked today, from the deep dive into what money is, to Bitcoin's unique digital DNA, its economic power, its resilience, and its potential future, how does this change how you think about value, about ownership, about the very idea of money in our increasingly digital world?
Lots to chew on there.
Definitely. And remember, you can explore all this in much more detail in Chris Millis's Ultimate Investment Thesis for Bitcoin. Find the link in the YouTube description or check the highlights tab on his X profile at Chris Millis again. That's Chris, Millas.
It's worth the read if this sparked your interest.
Absolutely. Thanks for joining us on this deep dive.